Good morning, everybody. Welcome back to another live stream here with the Everyday Growth Advisors. Welcome back into a new year. First live stream of the year. I had a really nice break. Got a little sick, but now I'm back. Yeah, we have a jam-packed schedule today. So if you are here and you're listening, you want ticker breakdowns to be done, go ahead, post it in the comments right now or the chat so that I can have a look at them later. But there's a lot to uncover, or rather to unpack. Okay, so let's get started here. We are still in the chop zone, which has been, the case for almost, I want to say, 2 weeks now or so. And we haven't quite made it out of the chop zone. Now, there are some things that are happening absolutely in the background that we definitely have to be aware of. The first thing that we are looking at is the dollar index and its continued slide down. Not only that, data that I'm looking at based on the CTA, which is the trend followers, showing that a lot of dumping of dollar is happening through FX denominated swaps. So we're looking at dollar being dumped against other currencies, and one of the predominantly dumped currencies right now is USD Japanese yen, and that's mainly because of the macroeconomic climate that is changing in Japan, and then the intervention from the central bank over there from BOJ almost a couple of weeks back, and traders are trying to cover some of that exposure that they have. So that's causing, a really pretty much significant weakness in the dollar, which, remember, at this point might not immediately translate to strength in equities. So there are a couple of things that are moving concurrently that might cause a scenario that will be not easy to figure out in the short run, because there's a lot of so imagine this, it's kind of like you're in a bit intersection, and there's a lot of traffic moving both ways, and the traffic lights have stopped working for a brief moment. And what I'm trying to get at here is there's a lot of action happening, and the dust needs to settle. So there's a lot of moving parts that are moving, and we aren't able to actually ascertain exactly what the outcome of these moving parts are going to be just yet, but we are seeing signs of possible volatility coming up. Now, there are a couple of thematic progressions that I'm probably looking at within the next 2 to 3 weeks. And so let's lay it all out on the table. First of all, today we have the Fed meeting minutes, which will be coming out at, I believe, around 2 p.m., which should be usually around 2 p.m. And in the FOMC meeting minutes, we are not really looking for a whole lot to change, except for focusing on 2 key issues, which is why the 2023 inflation forecast has gone up. And then second, of course, the step down in rate hikes, which was 50 basis points in December versus 75 basis points previously. And this is according to, I believe, Goldman Sachs. And Goldman Sachs, of course, still reiterates that they're expecting additional 3 25 basis point rate hikes, whereas the market is expecting 2 25 basis point rate hikes in this year. And so that would bring the peak federal funds terminal rate to about 5 to 5.25%, which is going to send a little bit of uncertainty to the market's ears. So that's one small thing that's happening today. Then another thing is we'll have JOLT reports, which is a job-related report that will be coming out as well. And then on Friday, we have non-farm payrolls, which is payroll numbers for, which will significantly also give us direction on unemployment rate. So all of these things, economic numbers that are about to come out, are going to impact market in different ways. And that's the reason why I'm saying that the traffic is going to be very high, and so volatility is going to come back in the next 1 to 2 weeks. Then we have FOMC, which will be on 31st to 1st January to February. Okay, and then 1, 2, 3 on the 20th. That means let's say 2 weeks before FOMC, we'll have OPEX, which is the 3rd Friday of the month, and so this will be options expiry day for the monthly options, and that will also cause a little bit of volatility. Then another layer on top of that is going to be earnings season, which is coming out within the next 1 to 2 weeks as well, with financials to report first, which is one of the reasons why many weeks back, almost 2 weeks back, we spoke about financials being bullish. And ever since then, financials have already retraced quite a fair bit, and we're looking for a possible rally in financials leading up to earnings. So there's then when we're talking about earnings, there's another layer that I want to preface here, because as I said, it's a complicated web, so you have to kind of de-layer everything and see what's going on under the hood. So the expectation for earnings is for earnings to be extremely dismal, right? The market is pricing in very peak pessimism. Okay, pessimism. So the market is not happy with the expectations of earnings coming up. And so if any earnings come out better than expected, you can imagine what's going to happen to shorts. They're going to be extremely squeezed, and we might see a rally in the S&P 500 temporarily, maybe the 3950, maybe the 4000, right? We could get a little squeeze to the upside here before another fall. So there's a lot of ways that this can go right now, and we're still watching for the situation to unfold. But for right now, right, as I said, there's complexity and layers that you're peeling back. Right now, we don't need to have so much of complexities and layers that you need to peel back. Right now, your vision and your range of view should be pretty simple. This box is all you got to trade between, right? And within this box, obviously the S&P 500 might be moving up and down, but within that up movement up and down, we have stocks under the hood that are buying and selling off aggressively. Okay, so what are some of these stocks that are trading aggressively under the hood? Let's get to some of those. Obviously, you guys have been following Tesla, which has been, ever since our call for bearish at $200, it is now down to almost half its value. Congratulations if you caught a move from it. I must have played this at least 2 or 3 times short now within the past couple of weeks, and that has absolutely contributed to my bottom line for the end of the year. For those of you that missed, the summary for my trading year, I closed out about $1 million in profits, all in all, and the last week of December brought me about $10,500 to cap off 2022. I'm hoping that this year I'll be able to break that target and get even higher, and we'll see what happens. Now, another development is, of course, TLT. And TLT has been finding some footing here at the $98 level. I spoke about TLT first and how we were bullish somewhere when we were up here, and I was talking about how I would like to be a buyer once we get back to about $100 once again. And I've been adding for a long position on bonds, especially the fat tail of the bonds, which is the 20+ year treasury notes. Now that we've come down back to $98 or $99 and bounced, and we are at 103, I'm looking to extend my bond allocation size. And remember that this is a trade that I'm going to be holding for many, many months, so it's almost like a leap, okay? And so this is another thematic trade that I'm looking at, a security that I'm looking to trade or hold for a extended period of time that would be beneficial. Now, the reason for this is a bit long for me to explain, but I will absolutely cover it. If you want the TLDR, essentially, my way of thinking why I want to go long bonds is 2 things. The first thing being that the Fed is likely to perform further quantitative tightening, and a lot of bond traders are going to try and lock in this high yield side of the bond market right now before yields start to go down again. Okay, and so I think that the resumption of bond purchases will continue as the market goes down. We might see a decoupling of the correlation between the S&P 500 and bonds, which has actually been, for the first time in history, going in the same direction, or rather it has happened very, very few times, I think. Okay, but this is the first time in the history where the 10-year bond returned negative yields for the year. Okay, in other words, return negative returns. So with the bond situation, I want to take upside trade on bonds into the mid of this year, so only trading for first half of 2023 as bonds start to get decoupled and uncorrelated from the S&P 500 in terms of movement. And that's just something that I'm looking at, forward looking. This is a macro play. This has a lot of things tied into it. Also, the fact that the dollar is weak should give some reprieve to the bonds as well. Okay, so that on its own, it's a trade on its own. Then next up is China, right? Beautiful entry yesterday on some BABA calls that we took. I took some $100 calls on BABA for 20th January. This week, I'm up $4,000 for the week. By the way, the gold trade that I took, I closed it out at minus 78%. I was expecting for the dollar to, get higher before it started, and then get gold to kind of move further down. But the opposite of exactly that happened. So you know what? When you're wrong, you admit it, and you just move on. I took the L on gold, and it was a $5,000 burn, but it is what it is, right? Sometimes you're not going to get all the macro part of the market right. So that was an unfortunate loss that I took this week, and all in all, still managed to claw back my way. Just yesterday, trading AMD, Boeing, Netflix, Apple, and now BABA's going to pay out really nicely this morning, because BABA is up about, I want to say 6.7%. So China has been pretty bullish. Now there's a couple things that why China has been bullish. The what was it? The Secretary of State promised that they're going to continue to support businesses. There's optimism around surrounding the reopening of China, and also the optimism past the peak wave of COVID infections. And so, yeah, that's pretty much what is happening with China right now. And a lot of Chinese stocks are rallying as to that effect. So that's one secular trend. Chinese equities, or rather emerging market equities, are looking up again, and it's been a pretty wild ride for them. So it's about time that they start recovering here, and we can start to take some exposure on them. Not to mention, wait for pullbacks and then obviously get in to further out expiries. So that's your first sector or secular trend that you should be looking at. Second up is financials, which I spoke about as a possible play 2 weeks ago, and ever since then we've bounced pretty strongly. This one had a very straightforward play behind it. Financials have been pretty much bought up pretty strongly the whole of last quarter. And this pullback that we got in the past 2 months or so, 1 to 2 months, I would say a month and a half, has really given us the opportunity to also reset for a additional bullish leg here into the earnings season of Q1 2023. And so that's all I really want to play here is the run up into earnings and then see how banks perform. If it's any consolation, I feel that there's too much of pessimism being built into the market right now in terms of what earnings compressions are going to look like. Even though I am in the camp that we are going to go through a recession this year, the question is, how bad of a recession are we going to go through? And no one can truly answer that question because it's just impossible to know. More importantly, how long the recession will be for, and how severe it'll be. These are things that you can't really guess, okay? You have to kind of wait and see and look at the economic data when it comes out. So financials is another sector that we're looking at right now to possibly play, okay? So those are two sectors. Those are two secular trends. There are more. I'm going to post them on the Discord and talk about them during our live trading sessions. I'm obviously not going to put everything out there, but I've given you guys a lot to think about already. I got to leave some for my team. So yesterday we had a very great first trading session with the team on Discord. Once again, if you're interested in joining us, make sure you tap on the description below. We have a link. And also, if you don't want to do that and you just want to help us support this channel, I really truly appreciate it if you hit the subscribe button and the like button to smash it so that the YouTube algorithm works its magic and helps to share this stream with people who are struggling with being profitable. And we do this for you guys, so I really do appreciate you guys taking our time out to be here. Okay, now let's talk technicals with the SPX and NASDAQ real quick, and then I'm going to take any ticker breakdowns, and that's going to be the end of the stream for today. Keep it short and sweet. So SPX still trading in a range here, and if it's any consolation, I think that this might be the day where we start to get choppy and extend further to the downside. Yesterday's price action was extremely bearish. We ended the day with a pretty nasty bearish engulfing candle on the previous session. And I think that this pullback here would be some shorts covering possibly, and then this level, which we are looking at currently where we are, the 3850 level is going to act as a significant resistance zone today. So 384, I think on SPY, or 383 basically, is going to be a significant resistance heading into today's price action, and it's only if we break above like 386 or so where we'll see that upward retest of 389 or even for 390, okay, on SPY, for those of you that are looking at SPY. If you are in 2023 and you're still looking at SPY, I think this is the year you should consider switching over and looking at an actual index like SPX 500 USD. For those of you that don't know, and I should probably tell you, looking at SPY and looking at index itself, it's two different things altogether. If you're looking at SPY and you constantly ask yourself if the gap is going to fill and things like that because it's so gappy, you're always going to be on the losing end, because SPY's chart is never going to be lined up with the actual index, not perfectly at least. You can see that there are times here where SPY looks like it has broken down below and you could get extremely bearish, versus that same period of time on SPX, where you would realize that we actually didn't break below, and we still remain within range pretty much. Very, very minutely broke out. These are small little things, not to mention that SPX itself is traded across multiple regions, so you're looking at all the market opens and closes. And so if you're looking to just look at the chart of SPX 500 USD, you should be trading or looking at this, looking up this ticker. It will give you the end to end between all exchanges. SPX 500 USD, that chart will give you the best price action with no gaps. And if you're in 2023 and you're still using SPY, I highly recommend you to switch over to this so that you can have a better understanding of how the market performs, and you get cleaner price action. Your charts will start to look better as well. Of course, their alternative is to use futures, which is a market on its own. So remember that if people are looking at futures, you must be a futures trader to use the futures chart. Looking at futures and trying to predict what is going to happen to S&P 500 is, I'm not gonna say the word, but it's a really dumb thing to do. Okay, because you have to remember that futures market is not the same as SPX, even though they look very same. They look very like a lot. Look very much the same, but they are not. Okay, they are not, because futures are used for hedging, and they're a different market on its own. Okay. Now NASDAQ, very, very wildly different chart on this one, right? And you can see that we broke down from the box on NASDAQ a while back, and we've been bearish ever since, right? Now we're in another consolidation range where this area has been a significant demand zone. Now, if NASDAQ does lose this demand zone, we need to get below 10,600 ish. The absolute low is like 10,437 actually. That's going to cause a ruckus, and it will send us back down into 9,000s on NASDAQ. Do I think this will happen like immediately, like within the next couple of weeks? I don't know. I don't think so. I think that there might be a little more sideways movement before we get that, especially after earnings. That's when it's more likely. So we're looking at maybe, you could say, the end of January, like FOMC meeting. Yes, that is a possibility. We might move further down. If earnings come out and things are really terrible and yada yada, then yes, we start to move further down. But I think until earnings come out and until we get a clear message about FOMC, I don't think that's going to happen. Okay. So as you can see, it's pretty complicated right now. There is no clear direction. We are range bound. It's pretty difficult to trade the indices themselves. So please avoid doing that. All right. You should stick with individual names. I've been sticking with things like Apple, which has just broken down below a very important area and a demand zone, right? And Apple can get obviously to 120 before it starts to even bounce. 122, 121. That's a very significant level for Apple to get to before we bounce. 61.8 extension as well. Yesterday we broke past the 38, and pre-market it looks like we've gone back up to backtest some of the pre-market levels, and I'm very, very certain that I think we might even get a little higher here to backtest some of these upper levels here before rejecting again and then heading back down. So that's still on the table for Apple and a possibility. Not to mention there has been a lot of breadth weakness. Just look at the mega caps, apart from Meta yesterday, which was insanely strong and has continued to be insanely strong after the pennant breakout, or this kind of a descending wedge breakout. We've seen Meta really show some of its strength, but then again, remember that this stock is wildly undervalued, and so I wouldn't be surprised that this keeps running, because investors are starting to see that the stock has intrinsic value. Okay. Semiconductors also with the continued choppy sideways action, and could continue to form a bear flag here after a big sell-off. Now, the long-term view of semis is still bullish because we're going to enter a boom cycle. But as of right now, the prices seem muted because of the expectation of earnings. And this is one thing that you have to always keep at the back of your head. Okay. So, okay, that's all I have in terms of briefing you guys on technicals and individual stocks. Let me look at some of the tickets right now. So, if somebody's requesting First Solar. Okay. So this one looks like possible head and shoulders that is going to turn into a possible bearish scenario if and only if you can break below this key pivot point here. Where did my tools go? There we go. So first solar looks like 144.75 is going to be a key pivot here. Of course, I think to be very, very safe, you want to wait till below 142.35. But it does look like a classic head and shoulder pattern that's waiting to break down on the 4 hour. This is your left shoulder, your right shoulder, and then your head right here. On the bigger time frame, this typically does work out. Obviously, don't take it with the confirmation, then only you can play this. Wait for that breakdown and wait for a little bit of a retrace on a 15-minute time frame. If you can get a continued rejection at the 144.75 level, then that gives you the green light to play this down into 127. Of course, there's going to be a couple of pit stops along the way. So let's have a look at where those are. We can use the Fibonacci tool here for that. Let me just change this up real quick. So definitely a lot of support levels on the way here, and you can see the 142.61 is the level that you actually need to wait for. So based on this Fibonacci extension here to the downside, you'll be looking at extensions at 139 to be the first level of defense if you do break below here. So the 144.75 level, if you do get a rejection after breaking down, should see 140 or 139 as the first target. And then 133 after that, if you can actually break through all these levels here. This seems like there's quite a bit of volume and price action in this area. Pair that over with the volume profile and have a look at where the most amount of volume is. So you'll see pretty obviously that the 61.8 level or 133 is going to be your biggest level of defense here. So very high chance that you'd see a big drop all the way down to around 135 to 133, 135. And this will be a sideways movement for a while after that for consolidation, either for the upside or downside within reason after that. So your target should be wait for the breakdown 144.75. If it doesn't break down 144.75 and reject 144.75, then the upside is still in play here for First Solar, and you should be cautious. Okay, that's the breakdown for First Solar. Netflix. Okay, so let's have a look. So Netflix has been another one that we've been watching and has been having pretty decent relative strength to the market, with like Meta. While the market was busy selling off last week, it did fall, quite significantly, but then recovered very quickly. And now it seems to be in kind of like a ascending pattern. Now, a very simple way to play this one is to wait for a breakdown or a breakout, either way. So the way that I will look at it is pretty simply that 301 or so, let's see here, okay, let's just call it 298 or 299. We're squeezing, right? This is a squeeze kind of pattern. So really simple. Ignore all my arrows because those are the trades, entries, and exits. But for this play, it's pretty simple. You're squeezing within the range here, and price action is squeezing to the upside. It can go either two ways. The first way is it breaks below and then kind of retests, and then it's gonna fall, right, to retest 290, and then after that 276 or 277. The other way it goes is it'll break out of 300, right? Don't play the breakout because you're still in risk of falling back and rejecting with the indices being so weak. Wait for the breakout and the retest of 298 to 300, and if you can actually get a bounce in this level, then the upside on Netflix should be pretty simple to secure up into 304 first, or 305, and then 311, which is going to be acting as your magnet points. So that's how I would play Netflix in the short term here, just from the technical standpoint. Does that make sense? Okay, and then last one, Tesla. This one is probably the most asked for. Tesla is still in a falling pattern, which is unlikely to resolve unless it can find a lot of big demand at this current level. If it continues to find no demand at the current level, the next stop for it is going to be at $90, $91 to $92. And below $91 and $92 is the $70 range where there's another support. in this range. It's going to be around 60, no, 70, basically $70 plus. I personally, I'm staying away from Tesla right now. I've only loaded some shares at like $120, 500 shares, and I'll be adding more Tesla shares if I can get a retracement or a bounce, and that's all. In terms of Tesla downside, you know, there is still potential downside to $92. That's where the end of the range is. But to try and catch this or plan a reversal, that's all going to depend on NASDAQ strength. It's going to depend on SPX strength. It's going to depend on whether you know, buyers step into Tesla. You have to look at the level 2 tape. You have to look at where unusual options activity is at as well. So that's all I have for you. Unfortunately, there is really no you know, specific way to play Tesla here, and it's in a very, very deep falling pattern. So you don't want to try and catch this knife. It's something that I would stay out until I see possible reversal or consolidation. We are not even in a consolidation just yet. All right. Well, I hope that was helpful for you guys. I know it was a little complicated, and you know, it could be difficult sometimes, but hey, I hope you guys enjoyed the live stream. If you did, leave a thumbs up, and also I'll see you guys back on Friday. Take care, and I'm going to jump on the Discord to trade with the team right now. Peace, guys.